Hi guys, it's great to see you again. I hope all of you are staying safe and staying healthy. So in this video, I'm gonna talk about what I've learned from week 6 of international finance. So enjoy this video. So the first thing that we're gonna talk about is the forecasting under market efficiency. Now in this section, let me highlight 3 important things that needs to be noted. The first one, if the foreign exchange market is weak for efficient, then the current exchange rates already reflect historical information. So the next one, if the market is semi-strong form efficient, then all the relevant public information is already reflected in the current exchange rates. And the final point, if the market is strong form efficient, then all the relevant public and private information is already reflected in the current exchange rates. So, volatile exchange rates make international trade and investment decisions more difficult. Why? Because volatility increases exchange rate risk. Exchange rate risk refers to the potential to lose money because of a change in the exchange rate. Now, the exchange rate volatility can be forecasted using 3 simple methods. The first one we have is recent or historical volatility. The second one we have is a historical time series of volatilities, which there may be a pattern in how the exchange rate volatility changes over time. And finally, the implied standard deviation derived from a currency option prices. So let's answer this question. Is the market efficient? Before we answer this question, let me talk to you about EMH. EMH, or Efficient Market Hypothesis, is a hypothesis in financial economics that states that asset price reflect all available information. So, from my point of view, I would see that this market is efficient. Why? Because a truly efficient market eliminates the possibility of beating the market, because any information available to any trader is already incorporated into the market price. So, like I mentioned before, exchange rate exposure may affect financing cost, investment return, and global competitiveness. Volatile cash flow from exchange rates changes and increase risk. So, with this, I can now highlight 3 types of exposure that needs to be noted, which are transaction exposure, economic exposure, and translation exposure. So the first one we have is the transaction exposure. What does this mean? The transaction exposure is the level of uncertainty businesses involved in international trade face. Specifically, it is the risk that currency exchange rates will fluctuate after a firm has already undertaken a financial obligation. So the second one we have is the economic exposure, which is a type of foreign exchange exposure caused by the effect of unexpected currency fluctuations on a company's future cash flows, foreign investments, and earnings. Economic exposure, also known as operating exposure, can have a substantial impact on a company's market value since it has far-reaching effects and is long-term in the nature. And finally, we have the translation exposure, or also known as the translation risk. This exposure is the risk that a company's equities, assets, liabilities, or income will change in value as a result of exchange rate changes. Now, this occurs when a firm denominates a portion of its equities, assets, liabilities, or income in a foreign currency. Now, this is also known as the accounting exposure. So that's it from this video. I hope you find this very useful, and I apologize if there's any mistake that I mentioned in this video. And thank you for watching this video, and looking forward to seeing you on the next video. And as always, stay safe and stay healthy. And until then, goodbye.